Welcome to our High Rock monthly video for June. Today we shall address how financial markets performed last month and the implications for your portfolios in the near term. Any key adjustments to our models and special mandates, and how our managing risk first philosophy will be the key to maintaining growth in uncertain times. I am Scott Tomlinson, and with me on the call today is Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division in 2015, and we are celebrating our 10-year anniversary. If you are interested in learning more about us, visit our website at www.highrockcapital.ca. Let's start with a recap of the month of May. Financial markets saw U.S. equity markets were stronger as tariff negotiations continued, and most other risk assets followed suit. Safer assets like gold, silver, bonds remain flat to slightly lower. Inflation and government debt and deficit levels appear to be weighing on bond markets. Paul, any commentary?
Yeah, I mean, wasn't a brutal month for bonds or gold for that matter, but
No, they
I
were
think
they were flat to slightly down,
yeah,
but everything else was performing, and they were sort of lagging.
yeah, and perhaps some of these, especially U.S. equities, were extremely oversold, and we were fortunate enough to be buying some down in early April at darn close to the bottom, if not the bottom. So it was a bit of a reversion to the mean, I think, in some of these riskier assets that performed a lot better through April than May. But yeah, I still think that overall, this is really being driven, whether it's this whole tariff war thing is all being driven because, quite frankly, the U.S. is in a Canada's not far behind either in a fiscal debt crisis, and I think that's what's drawing capital to both cryptocurrencies and gold and silver. Silver starting to really pump up here as well the last few days as we're into June 10th today.
And one of the things that we had talked about earlier today was how the Canadian dollar has moved, and certainly when we look back over the last 5.5 years or so, we've seen some pretty significant moves, and we saw a pretty significant move at the beginning of this year. It seems to be heading back to, as you said, that longer term average, and that's interesting in and of itself. I don't know if you have any comments on that.
I do like for a question. What is the Canadian dollar and the Canadian stock market just really uh, moving here to stronger points just because there's such a hate on for both the US dollar, and there was for US equities, although they're almost back to where they were too. But the US dollar is getting hammered. I don't know why the Canadian dollar is much of a beneficiary because uh, somebody's got to explain it to me. But unless these tariffs just all go away. But even today, as we talk, I mean, the auto industry, which is a big part of the Ontario economy, is halted. And I mean, I think this is absolutely horrific for Canada. So I don't know. The dollar's strengthened, the equity markets, the Canadian stock market has improved right back to new highs. It's interesting. Not what we would have thought.
Yeah, and I think in a behind the scenes kind of perspective, we don't really know what's happening. We're not given a whole lot of information. So there has been as a result, there's been less of that sort of panic that was driving the sell-off, and now people are wondering what to do with all the cash that they have, and I think that's drawing more money back into riskier assets, and that to me, and maybe to you too, because we're relatively conservative in our thinking, but I think it may be a little bit too soon. When the tariff pause is off in about a month, or as we get closer to that, and there hasn't been any deals done yet, right? So I think markets are in pause mode, but generally cash is drifting back in ever so slightly, and that's driving markets up, probably on relatively thin volumes.
Yeah, well, sticking with that U.S. theme and tariffs, there's now a new acronym, TACO. Trump always chickens out, and so the market's caught on to all this now, and it's certainly gotten ahead of them. So
Yeah. All right. Well, let's continue chatting about our balanced mandate a little bit. In comparison to, as we do each month, we look at the Morningstar uh, averages for balanced mandates, and certainly May was a better month, bringing it from negative territory at the end of April to a positive territory for the year in May. Again, it's great to be back to growth, but we tend to want to focus on longer periods of time. So we tend to look at the longer averages, the 5-year average, uh, or the 5-year annual average returns remain reasonably strong. And as is High Rock's philosophy and methodology, we focus on risk adjusted returns, or return as a function of the risk we are taking. The Morningstar average is about 0.75% return for each unit of risk over that 5-year period. Well, High Rock clients, again, depending on your portfolio strategy, would likely see something closer to 1%, as we are able to keep the volatility lower. If you wish to discuss your portfolio performance relative to these averages, we are always available to have those conversations. So please feel free to reach out. Any updates you want to share on the high yield and preferred share mandates, Paul?
yeah, month of May, high yield, first of all, was okay. It was not a huge month, but bonds performed pretty well, and as the old adage says, kind of just clipping the coupons. So that's nice and steady Eddie type of month that we're always happy to have. The preferred share mandate had a very good month. April was much tougher, if people recall, on these two mandates, high yield and prefs. High yield actually performed pretty well in April, so it didn't need to make back a whole bunch, whereas prefs had a pretty rough month in April, but an even better month in May. So they made back even more than we were down in April. So really, really good month. That pref market, banks continue to redeem when they have that option, redeem pref. So that market has really shrunk over the last year and a half that we've had the mandate open, and it's just been a spectacular investment or trade. And we continue with the same sort of methodology in that mandate.
Well, this year to date, the preferred shares, or our preferred share mandate, is one of the best performing asset classes out there, given all of the volatility in some of the other asset classes. So that's pretty decent.
Yeah, pretty happy with it. Very happy with it.
And as you said, when we go through a year of clipping coupons, usually that yields about a 7 or thereabouts cash yield on that on the high yield mandate. So that's nothing to be upset about it either, right?
Nope, the rule is 72. 7% over 10 years doubles your money.
Well, there you go. As always is the case, we focus on our clients' long-term goals and their long-term planning, and strategy is built around that. We certainly want to update all of our clients' strategies as we go forward, and at least once per year, if not more. And we look to our clients to contact us when they're ready to have those conversations. If they haven't heard from us, usually we'll let you know once a quarter that you're ready for a review. if you have time, we certainly want to be talking and helping you move forward to those goals. Something that I was reading recently was how the inflation outlook might look, and with 1 month to go until the Trump administration's reciprocal tariffs are at least, they're set to expire. Market participants continue to, as I said, take a pretty relaxed view of the risks around U.S. trade policy, and that probably makes some sense given the administration has ultimately shied away, as you said, Paul, from measures that would do major damage to key asset markets, right? So although there may be some renewed jitters as that deadline draws near, something that economists are focusing on is the inflation swap curve, which is a forward looking metric for inflation expectations. So what capital economics is telling us is that the uptick in inflation expectations towards 3% is roughly consistent with a 10% universal tariff and a higher effective rate, perhaps 40% or so on imports from China, which is all built into current asset pricing. The other key assumption embedded in the inflation swap and interest rate markets is more optimistic, that tariff-driven inflation will not prove persistent and that the Fed will resume policy easing before too long. And again, this is according to the outlook at Capital Economics. I don't know if you have any comments on that, Paul, but I think found it rather interesting.
Yeah, no, I don't really have too many comments on it. I think we'd be the market's probably pretty happy if it comes up with only 3% inflation as per that chart.
Yeah, well, I think one of the things it's looking at is the other impacts on inflation. Certainly, oil prices are one, and food being another, as well as what's happening on the employment front, where employment is or wage increases are not robust as they have been in the last few years. Okay, so let's talk a little bit about the global equity strategy. As Paul was mentioning earlier, we do buy when we see markets panicking, and when markets improve, if they have, we tend to rebalance back to higher weightings of cash when the opportunity rises, especially when we're creating cash flow for some of our more retired clients. So we'll certainly be doing that with the fear and greed index back into greed territory. So that gives us just sort of a comfort when we do have to do some selling. And so for the time being, that's how we'll be trading the global equity model. Paul, do you want to talk about tactical strategy?
Sure. Not a whole bunch to add. Within tactical, we did have one very, very tiny, it's de minimis position that the Sherritt bond finally went through our reorg department. It was about a month late, but so that'll show up on people's statements. One of our biggest positions in Source Energy improved over May. It's had a big day today on June 10th, so it continues to improve. This stock is still really, really cheap, and it actually is dealing with 25% import tariffs from the sand from the U.S. So the Canadian government has placed an import tariff on this fracking sand that Source gets out of their mine in Wisconsin and trains up to the Western Canadian Sedimentary Basin. They've applied and have been applying, even when the Trudeau government was in place, for an exemption on this tariff. But I know the cost of the tariff is being split by the oil producers, the pumpers, and Source Energy themselves. So it's not like any one user is paying the entire cost of the tariff. Still like that stock, and I think it's grossly overvalued or undervalued right now. Other energy name that has not done all that well is Baytex Energy. They're largely an oil producer, roughly 60% in the US, 40% in Canada. They run a little bit more leverage than the average oil company, but oil's had a pretty rough go lately, and that's certainly why. Now, again, today was a big day, up 6.6% on that stock. So it's got a ways to go, I would say. But we'll see what happens with the price of oil. Who knows what OPEC ends up doing. That's really about it for tactical, Scott.
Yeah, interestingly, I was reading today that OPEC's outlook is for a significant increase in oil demand as we move forward, and I think it probably has to do a lot with the position that the U.S. administration is taking towards green energy and renewable energy as well. So from a macro perspective, greater demand probably is not a bad thing for our fossil fuel positions.
Yeah, that's true. But again, we just never know what OPEC is going to do, and they matter. So
Yeah.
we'll see.
Okay. Fixed income.
Yeah, we did one extension trade out of a 2026 Ford bond into a 2031 Ford bond. So we took a little bit more duration risk with that. That was just one trade. Preferred shares, I mentioned earlier, they added value, had a very good month. And it was otherwise quite stable if you look at it. I mean, 5-year Government of Canada bond yield, I think across the whole month, it was up maybe 10 basis points, which is nothing, 0.10%. So that's really not much. And then the Canadian dollar, it improved very, very marginally. So that didn't really hurt us. The month of April, the Canadian dollar improved quite dramatically. So as we talked about before, so that detracts from performance on our US dollar assets, which we hold the average portfolio roughly 20%. That's about
Just
it for.
backing up ever so slightly to talk about duration, just to clarify what duration is all about, is really moving out the maturity spectrum in time. So when you're moving out the maturity spectrum in time, I'm assuming that you're picking up some yield in that as well.
Yeah, we did for sure. We, bought a lower coupon bond, but that's reflected in the lower price that we paid for. So yeah, we're picking up a little bit more overall yield.
Tremendous. Okay, well, thanks for that. All right, as always, we want to take the time. We want to thank you for taking the time out of your busy schedules to tune in. We will be back with our next update at the beginning of July. So until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Diane, we want to wish you all the best until just after Canada Day, and hopefully your summers all start very warm and enjoyably.